What is an income statement? An income statement is one of the three main financial reports that companies publish, alongside the balance sheet and cash flow statement. In simple terms, it shows a company's performance over a period of time, usually a quarter or a year. Instead of a snapshot like the balance sheet, the income statement is more like a movie. It tells the story of how much money came in, or revenue, how much went out, or expenses, and what was left at the end, profit or loss. You might also hear it called a profit and loss statement or simply a P and L. They're all the same thing. Why does it matter? The income statement matters because it shows whether a company is actually making money. Investors use it to see, is revenue growing? Are costs under control? Is the company profitable or is it losing money? For the business itself, it's a reality check. A company might have lots of assets on paper, but if it isn't generating profits, its long-term survival could be at risk. Emotionally, income statements give reassurance or a warning. If profits are strong, it can build confidence. If losses are piling up, it can highlight danger signs early. And like the balance sheet, it's not only investors who care, banks, suppliers, and even employees look at income statements to understand the company's financial performance. For publicly listed companies, these statements are published every quarter and every year as part of their official earnings release. They're also discussed in detail during earnings calls with analysts and shareholders. Here's a simple example. Let's return to our small bakery. In 1 year, it earns £100,000 in sales, revenue, spends £30,000 on ingredients, £20,000 on wages, £10,000 on rent and bills, and £5,000 on other expenses. Total expenses is equal to £65,000. So profit before tax equals £100,000 minus £65,000, which gives us £35,000. After paying £5,000 in tax, the final profit, sometimes called net income, is £30,000. That means the bakery made a net margin of 30%, profit of £30,000 from £100,000 sales. Margins like this are a key way investors compare efficiency between different businesses. The income statement shows this clearly, so you can see how the bakery moved from sales all the way down to profit. You can even think of your own monthly budget as a personal income statement. Salary in, bills and costs out, and savings or debt left at the end. What else should you know? There are a few extra points that make income statements more useful. It covers a time period. Unlike the balance sheet, a snapshot, the income statement shows performance over time, like for the year ending 31st December. Top line versus bottom line. Revenue, the top line, shows how much money came in. Net income, the bottom line, shows what's left after everything is paid. Layers of profit. Many income statements show multiple levels, operating profit from core business and net profit after interest and tax. This helps you see where money is being made or lost. Non-cash items. Some expenses, like depreciation, the gradual cost of equipment wearing out, don't involve actual cash leaving the business, but still affect profit. Comparisons matter. A single year doesn't mean much on its own. The real insight comes from comparing several periods or against other companies in the same industry. Limitations. Companies sometimes make accounting choices that can smooth or polish their results, such as recognizing revenue early or delaying certain expenses. This means the income statement should be read with a critical eye. It links with the other statements. Strong profits are positive, but they don't guarantee cash in the bank. That's why the income statement is best understood alongside the balance sheet and cash flow statement. To sum it all up, an income statement is a company's financial movie reel, showing revenue, expenses, and profit over time. It's a vital way to judge whether a business is making money and how sustainable that performance looks. But remember, it's only part of the bigger picture. To truly understand a company's health, it should always be read alongside the balance sheet and cash flow statement. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.